Muy bien. Ella agrees in. Trust we are doing good. Tonight, we shall be looking at dividend policy. I'm aware I have two groups of students tonight. The regular online students, and for some reasons, we have some students joining us from the physical class. We are looking at dividend policy. There are three responsibilities of finance manager. There are three responsibilities of finance manager. One is investment decision making. There are three responsibilities of finance manager. One is investment decision making. The second is financing decision. And the third is dividend decision. Our discussion tonight shall center on dividend decision. What is dividends? Why is dividend decision important to finance manager? Is dividend payment compulsory? Some of these questions shall be addressed in our online class tonight. Dividends can be defined. I'm going to share my screen soon. Dividend can be defined as that percentage of company's profits that is distributed in the form of cash. That percentage of company's profits that is distributed in the form of cash. What are the theories of dividend policies? We have defined dividends. The proportion of company's profits that is distributed in the form of cash. Dividend payments is at the discretion of the company's director. The director might decide to pay dividends or not to pay dividends. Please note, it is not mandatory companies to pay dividends? It is the decision of the finance director. Please always remember, you are the finance director. The accountant will act as the finance director. It is your responsibility to decide whether to pay dividend to the shareholders or not to pay dividend to the shareholders. It is also your responsibility to decide what percentage of company's profits to pay as dividends if the company is willing to pay dividends. Theories of dividend policy. There are several theories of dividend policy. Please listen very well here. There are several theories of dividend policy. These theories are intended to identify the optimal amount of dividends these theories are intended to identify the optimal amount of dividends that a company should pay to shareholders. Please note, when we say optimal amount of dividends, the optimal amounts represents the amount paid that maximizes the company's market value. Let me take that again. The optimum amount of dividend payments is the amount of dividend paid that maximizes the company's market value. Now the question is, does dividend payments affect company's market value? Please note that question. The argument between theorists, was, does dividend policy or does dividend payments affect market value? There were several arguments between different schools of thought. There are three major schools of thought on dividend policy. There are three major schools of thought on dividend policy. One is the traditional view of dividend policy, also known as the relevance theory of dividends. Number one is the traditional view of dividend policy. Let us explain traditional view. The traditional view of dividend policy is that the amount of dividend paid should be at the level that enables a company to maximize value of its shares. The argument of the traditional school is a company should pay dividends regularly. The arguments or the position of the traditional school of thought is that companies should pay dividends consistently, because payment of dividends will enhance a company's market value. Please note down the arguments of the traditional school of thought was that a company should consistently pay dividends to shareholders, because payment of dividends will enhance company's market value. Hence, a company should pay amount of dividends that maximizes the company's market value of equity. The traditional school of thought is also known as relevance theory of dividends. Relevance, meaning that dividend payment is relevant to company's market value. Please note this down in your... The position of the traditional school is that dividend payment is relevant to company's market value. Hence, companies should consistently pay dividends. And there is an optimal dividend policy. There's an optimal dividend policy. The optimal dividend policy is achieved at dividend level that maximizes company's market value. The argument of the traditional school are premised on the following points. That is, they supported their position that dividend payment is relevant. Companies should pay in dividends regularly. They supported their theory with the following points. 1, dividend signals. Number 1, dividend signaling. This means that dividend payments is a means of communicating to the shareholders and the investing public about a company's performance. Dividend signals. That is, dividend is a means of sending signals to the investors and to the investing public about the performance of a company. What we are trying to say is, if you have two companies, company A and B, company A is always paying dividend to shareholders, while company B is not paying dividend to shareholders. The people will believe that company A is doing well. People will be willing to invest in company A. Therefore, dividend payments can be used as a means of sending signals to the investors about the performance of a company. Point number 2, preference for current income. Many investors will prefer to have their returns in the form of cash. Many investors will prefer to have their return in the form of cash, current income. They will prefer to have their return immediately in the form of cash, as opposed to capital gain. Now the choice is, if a company pays dividends, you have your return in the form of cash. If a company is not paying dividends, that means the company will reinvest your money in the business for future growth. That future growth is what we call capital appreciation or capital growth. Many investors will prefer to have cash dividends as opposed to future capital gain. Many investors will prefer to get their return in the form of cash. Point number 3. Resolution of uncertainty. Dividend payments. One of the arguments often put forward for high dividend payouts is that income in the form of dividend is more secured than income in the form of capital gain. If you invest in company, you will prefer to get your return in the form of cash. Dividend payments is a resolution of future uncertainty. For example, if I invest in Fourth Bank, I would prefer to have my return in the form of cash, as opposed to reinvesting my money for future growth. Future growth, we are not sure what will happen at future. Future growth creates uncertainty. Hence, dividend payments is a resolution of uncertainty. Then point number 4. In many instances, taxation. The point number 4 is taxation. In many instances, income in the form of dividends is taxed in a different way from income in the form of capital gain. Please note, when we say capital gain is when you dispose your shares and you get return on your shares. That return is called capital gain. Hello? Capital gain is where an investor disposes his or her shares. The return derived from the disposal of shares is what we call capital gain. Now, when it comes to taxation, the taxation on dividends is different from taxation on capital gain. Because of these differences, this distortion in the personal tax system can have impact on investors' preference. Some investors will prefer cash dividends, while some investors will prefer capital growth. That will now create problem for the company. In summary, the position of the traditional school is that companies should continue to pay dividends because dividend payments will maximize companies' market value. The second school of thought, Modigliani and Miller, dividends irrelevance theory. Modigliani and Miller, dividends irrelevant theory. Modigliani and Miller developed a theory to suggest that dividend policy is not relevant. Modigliani and Miller developed a theory to suggest that dividend policy is not relevant, and the level of dividend paid out by a company does not matter. The total market value of the company will be the same. The amounts paid as dividends, the position of the Modigliani and Miller was that regardless of the percentage paid as dividends, companies' market value remain the same. If you like, don't pay dividends. If you like, pay 100% of your profit as dividends. Or in between, pay 30%, pay 20%, or 50%. This will not affect a company's market value. That is the position of Modigliani and Miller. That is the position of Modigliani and Miller. Hence, to Modigliani and Miller, dividend payments does not have impact on a company's market value. Their theory was developed upon certain assumptions. One of the assumptions is that one of the assumptions is a tax-free economy. If there is no taxation, then dividend payments or dividend policy is not relevant to companies' market value. Please note, MMM is not saying you should not pay dividends. So if you like, pay dividends. Please note this point. Modigliani and Miller is not saying that companies should not pay dividends. Company can decide to pay dividends, or company can decide not to pay dividends. Their argument is dividend payments does not have impact on companies' market value. To Modigliani and Miller, what matters is a company's earnings capacity. M&M argued that the value of a company's shares depend on the rate of return. The rate of return it can earn on its business. Look at the argument. That look, why are we burdening ourselves about dividend policy? If you want to enhance companies' market value, companies should identify viable projects and invest in viable projects. What determines a company's market value is the ability to generate earnings, not dividend policy. Just 1 minute. All right, let's go on. To M&M, if a company is not paying dividends, companies should identify viable projects and invest. Provided company invest in viable projects. When we say viable project with positive net present value. This will increase companies' market. Now, where company is not paying dividends, the shareholder does not need to wait for company to pay dividends. You can manufacture your own dividends. You can sell some of your shares and generate cash. The assumption is there is no taxation. The assumption of M&M model is that, one, there is no taxation in the economy. Hence, you are not going to incur tax on capital gain. There is no transaction cost. In as much as there is no transaction cost, buying and selling of shares does not involve cost. There is no issue cost. It assumes a perfect market situation. But in reality, Modigliani and Miller theory may not work. In practice, the argument of M&M may not work because there is no perfect market situation. Market imperfections we make it impossible for the argument of Modigliani and Miller to hold true. Then lastly, we have the residual theory of dividend policy. The residual theory of dividend policy is that there's an optimal amount of dividends. Let me take that again. the residual theory of dividends is based on the argument that every company has an optimal dividend policy. As an optimal or an optimum dividend payment. And that optimum dividend payments can be achieved as follows. If you are trying to achieve optimum dividend payments, the company should follow this procedure. 1, a company should identify investment opportunity that will have positive net present value. Companies should identify investment opportunity with positive net present value and invest in such business. By investing in such business, by investing in positive net present value business, that will increase the company's value. Point number 2, the capital to invest, the capital to finance these projects should be obtained internally from earnings. If the company has identified viable projects, the viable project should be financed from the company's profits, earnings. The amount of dividend paid by company should be the residual amount of earnings. When we say residual, company will only pay dividends after all viable projects has been exhausted. Company will only pay dividends after the company has financed all viable investment projects from retained earnings. The residual of earnings. When we say residual, the net available cash after we have financed all projects. That's what we call residual. The residual earnings we can now be applied to pay dividends. In this way, the company will maximize its total market value. Let me quickly add that residual policy emanated from Modigliani and Miller theory. Let me quickly say that residual policy is derived from Modigliani and Miller theory. The company should first invest in viable projects. When you are done with all investments, and remaining cash can be used for dividend payments. By so doing, you are going to maximize company's market value. problem with residual theory is that annual dividends will fluctuate depending on the availability of viable capital projects, depending on the availability of viable capital projects. In this case, shareholders cannot predict what dividends they should expect. So please note the three theories, note the line of argument. Our next discussion, dividend capacity. When we say company's dividend capacity, this can simply be defined as the ability of a firm to pay dividend to shareholders at any time. Dividend capacity can be defined as the ability at any given time of the firm to pay dividend to shareholders. Company's dividend capacity. We have a direct impact on its ability to implement dividend policy. A firm's dividend capacity is determined by the accumulated distributable profits. Please note these points. When we say dividend capacity, it implies free cash flows to equity. Cash flows available to equity shareholders. The level of cash flow available will be the main driver of the amount a firm can pay as dividends. Please note that. Factors influencing dividend policy. One is legal position. Under the law, a company's dividend capacity is determined by the amount of distributable profits. Point number two, level of profitability. A company can only be talking of dividend payments if that company is profitable. Is that not, please? A company can only be talking of dividend payments if that company is making profits. However, please note, company can also pay dividends even if the company sustains loss. The growth rates. Rapidly growing companies commonly pay low dividends. If a company is undergoing growth process, the company may pay less dividends. Controls. We say control and ownership. The use of internally generated funds does not alter ownership control. At times, company might decide not to pay dividends or reduce dividend payments in order to finance future projects, so as to preserve what? Ownership and control structure. Liquidity and cash flow. We have explained this before. The level of liquidity has a direct impact on dividend payments. Then we'll talk of taxation. Where a company is exposed to higher tax will reduce company's profits. And that can reduce the amount available for dividend payments. What is the objective of dividend policy? When deciding on how much cash to distribute to shareholders, the directors must keep in mind that the firm objective is to maximize shareholders' wealth. Hello? If the examiner asks you that, determine the amounts, you are playing the role of finance manager, and you are asked to recommend dividend payments for the company. You must bear in mind that the firm's objective is to maximize shareholders' wealth. Hence, you are going to decide on dividend policy or dividend payment that maximizes shareholders' wealth. Is that point clear, please? Is that point clear, please?
Yes, I see.
Yeah, Amaka. Where's Zainab? She online tonight? Okay.
Yes, sir. Good evening, sir.
Zainab.
Yes, sir.
Okay,
Thank you.
Okay, yes, Fidelis.
Hello, sir. Good evening, sir. Happy Wednesday, sir.
See Fidelis.
Good evening, sir.
Wishing. I'm not seeing wish. Okay, believe. Believe is online too. So please note my points. If you are asked to recommend dividend policy, remember that the objective of a company is to maximize the wealth of the owners. So you are going to look at that dividend payment that maximizes shareholders' value. I can see white dots. Where's Mide? Ewa. Okay. Let's round up this discussion. forms of dividend payments. One is cash dividends. We are used to this. Most of us, we have investments in companies. Forms of dividend payment. One is cash dividends. It's the most common form of dividend payments. It is effected through share warrants. Currently, we have e-dividends, where company will pay you cash. Under the e-dividends, at the end of the financial year, your account will be credited with your dividends. Number two, we have scrip dividends. Scrip dividends, otherwise known as stock dividends. As an alternative to cash dividends, the company can issue additional shares to shareholders. A scrip dividend is a dividend paid in the form of new shares. A scrip dividend is dividend paid in the form of new shares. Instead of receiving cash, the shareholders will receive new shares. Instead of receiving cash, the shareholders will receive new shares. Please note, the rules of the stock exchange might require that when a company wants to make a scrip dividend, it must offer a cash dividend as an alternative. If a company is doing stock dividends, stock exchange rule says that you must also provide an alternative cash dividend. The choice is for the shareholder whether to accept stock dividends or accept scrip dividends. Please note that. Number three, we have share repurchase. If a company has surplus cash and the company is overcapitalized, when we say overcapitalized, company have excess capital than required, it might decide to repurchase some of its shares as an alternative to paying out higher dividends. Share repurchase simply means buying back company shares from the stock market and returning cash back to the shareholders. We have stock splits, although stock splits is not a form of return really. Stock splits. This occurs when a company perceives that its stock price may be too high. This occurs when a company perceives that its stock price may be too high. Stock splits are usually done to increase shares outstanding and to make it more affordable for the investor to buy a regular lot of shares. When a company involved in stock splits, and ordinary shares, for example, each ordinary share of 2 naira each can be split into 2 shares of 1 naira each. Before, I can now say get 2 shares for 1 naira each. Number of shares will increase, but the naira amount will remain unchanged. Number of shares will increase, but the naira amount remain unchanged. We can now look at bonus issue. Bonus issue is an invitation to existing shareholders to purchase additional shares in the company. No, that's right issue. Bonus issue, otherwise known as scrip issue or capitalization issue, is the issue of additional shares to existing shareholders in the form of bonus. Issue of additional shares to existing shareholders in the form of bonus. It involves no cost. Bonus issue is the capitalization of equity reserves. So company can issue bonus shares to shareholders. We have explained right issue before, but let's round up with right issue. Right issue is the issue of new shares to existing shareholders, usually at a reduced price. It's an invitation to existing shareholders to purchase additional shares in the company. The new shares or the right to purchase new shares is always at a discount. So, ladies and gentlemen, we are done with the explanation of dividend policy.
So I have a question, please.
Yeah, who is speaking, please?
It's Prosper, sir.
All right, Prosper, please go ahead.
Yes, sir, please, can you explain like the difference between the stock split you mentioned earlier and then the right issue?
Stock split and right issue.
Yes, sir.
Right issue is not in dispute. Is that not? Amaka, right
Sir?
issue. There's no dispute about it.
Yes, sir. There is none, but the stock split looks more like it.
Okay, let me explain stock split.
Okay. Yes, sir.
Stock split. First is, under what circumstance will a company embark on stock split? Under what circumstance will a company consider stock split? If a company perceives that its share price, its stock price is too high, the share price at the stock market is becoming too high, and people are not buying your shares, the company can decide to go into stock split. What is stock split? The stock split, the share will be split into two. For example, a share. Let's assume your company shares sold for 100 naira per share. At the stock market. And you perceive that this price is too high. You can say, okay, let us do stock splits. Let us say one share for 100 naira now. That's okay. Let us do 2 shares, 50 naira each. You know, you have reduced the price. 2 shares now goes for 50 naira. Please, 2 shares multiplied by 50 naira each. That will still give you 100 naira. Is that not, please? Is that not, please?
It is, sir.
Number of shares will increase. But the total amount, your share capital in naira amount will remain the same. Now, stock split has nothing to do with existing shareholders. That was why I said, when I say differentiate between stock split and right issue. Stock split has nothing to do with existing shareholders.
Hello, sir. Hello, sir.
The company only say, okay, we are splitting our stock. That look, oh, at stock market, all the shares now, a share that sold for 100 naira, we are splitting that shares into 2. 2 shares now, each for 50 naira. The quantity of shares will increase. Price per share will fall. But total share capital remain unchanged.
Okay, sir. Hello, sir. Can I ask a question?
Yes, please.
Okay. Now, still regarding this issue of stock split. Now, those shareholders are... Hello?
Yes.
Okay. Now, the shareholders that still have the shares of, out of, let's say, 100 naira, and the other shareholders that have the shares of 50 naira, if they are paying dividends, will they carry the same weight?
Okay. The stock split, dividend will affect everybody. Pile of shares you have. What I think we should take out of this, so that we can be able to minimize confusion, if there's any. The objective of stock splits is to reduce price per share, so as to make the shares more attractive for people to buy. The objective of stock splits,
okay,
look at this, creating cheaper shares with greater marketability. The objective of stock splits is to make the shares cheaper for investors to buy. Is that clear, please?
Yes, sir, it is.
So that we don't keep on. All right. We shall be moving to the first question. Then, after we are done with the question, we move to the whiteboard for solution. You can look at your study pack. For the student that joined tonight, you can look at your study pack. Look at page 155 of your study pack. We are looking at question number Pinko Industrial Services. You can open your study pack. That should be question number 4 in your study pack. Let us look at the question together. Pinko Industrial Services. Okay, can somebody read the question? Let me rest more. Alexia, are you online? Okay, Zainab with yourself. Zainab, are you available?
Yes, sir.
Okay, Madam Zainab, sorry to bother you. Please read the question.
Okay. So, Bimco Industrial Services is an all-equity finance and stock exchange listed company.
Okay.
Over recent years. Can you hear me?
I can hear you.
Okay, let me adjust now.
But if it's
Okay,
possible to
Bimco.
increase your voice, fine.
Okay. Okay. Bimco Industrial Services. Is it okay now?
Yes, it's fine.
Okay. Bimco Industrial Services is an all-equity finance and stock exchange listed company. Over recent years, the company's management has adopted a fairly cautious and conservative policy of not seeking expansion, but has been contented to earn a steady level of profits, most of which has been distributed as dividends.
Please notice, most of the company's profits has been distributed as dividends. All right.
So recently, there have been some personnel charges at the board level, with the result that the company has more actively been seeking new investment opportunities. In the financial year which just ended, the company reported profit of 50 million, a similar figure to that of recent years.
Okay.
It has been estimated that the company cost of equity is 15% per annum.
Cost of equity 15% per annum.
Four investment projects have been identified, all of which could commence immediately. The estimated cash flows and the timing of these projects are as follows.
Okay.
So the table, project A, B, C, and D,
Okay.
in millions. So year 0 to 5.
We can all see the table. Please go on.
So each of these projects is in the same risk class as the company's existing projects. You have been asked by the board to give your advice on the dividend policy at the next week's board meeting. Required: calculate how much Bimco Industrial Services should pay to shareholders as dividend in respect of the company's financial year just ended, assuming the Modigliani and Miller were correct. Proposition on dividend policy. You should ignore taxation in the calculation.
All right, let's deal with requirement A. The question says, thank you, Zainab. Thank you. It's not easy to be at the top of your voice. All right, thank you.
Yes, sir.
Requirement A says, calculate how much Bimco Industrial Services should pay to share as dividends in respect of the company's financial year, which has just ended, assuming that Modigliani and Miller were correct in their original 1961 propositions on dividend policy. What the question is saying is that based on M&M model, what amount should we pay as dividends? All right. Please, who can explain? The company has 4 projects. Look at it. The company has 50 million profits. The company has 4 projects. Examiner says, recommend the amounts to pay as dividend out of these 50 million based on Modigliani and Miller theory. Should we pay the full 50 million as dividends, or should we not pay dividends? Or how much should we pay as dividends? Now you are the finance manager. Yes, any suggestion? How do we go about it? I want to share the whiteboard. Let me see. I don't want this one. No. I don't want the. Okay. Yes, the class is open. Please get your study pack, and those that have the printed copies, let's go to it. Now the question to the class. Out of this 50 million, based on Modigliani and Miller, how much should the company pay as dividend to shareholders? The line is open. Who can explain Modigliani and Miller theory for us?
The M&M opine that, okay.
If
Sir,
I can see your speaker is. Oh, you want to?
I'm trying to, explain
Why?
the M&M Miller theory.
Yes, please explain.
Based on what you just taught us, it is believed that M&M, the Modigliani and Miller theory, believes that dividend policy is not relevant, and the level of dividend policy by the company does not matter. So the total market value of the company is the same, regardless of the amount that is paid as dividend.
Brilliant.
So
how much should we pay? Or we should not pay dividends?
They can pay the whole as dividend. It doesn't matter based on M&M Miller theory.
Thank you. You have answered the question at least 70%. The company can decide to pay the whole 50 million as dividends, or pay no dividend at all. Alternatively, the company can identify viable projects, finance viable projects first. Then any balance remaining can be used to pay dividends. That is the position of M&M. You have been able to answer at least 70% correct. That the company can decide to pay the 50 million as dividends, or pay no dividend. Or the company can identify viable projects, finance viable projects. The balance remaining can be applied to dividend payment. Now look at the question. We have 4 projects. Is that not, please?
Yes, sir.
All right. Let us determine the net present value of each project. Is that clear, please? All right. Let us calculate our working one. Calculation of projects net present value. We start with project A. Please, can I have the information for project A? How many years? Please,
Year
let's
0
speak.
to 5.
Project A, how many years?
Okay,
All is 5
3
years.
years. 3 years.
No, check the question. Project A is for 3 years.
Okay, 3 years, yes.
3
Arrow,
years.
year 1 to 3. Thank you. Cash flow from project A. What is the initial amount of project A?
20 million.
20 million.
20 million, please. Project A, look at it. 20 million naira. Can we all see it?
Yeah.
What is the cash inflow for project A?
7.5 million.
7.5. Thank you. We now move to the discount factor. What is this company cost of equity?
15%.
That is the discount factor. Because this company is all equity finance. Please note, if a company is all equity finance, the appropriate discount rate for the project is the cost of equity. Please note this down. If a company is all equity finance, the appropriate discount rate for the company's project is the cost of equity.
So I can ask a question?
Yes, sir.
Okay, what if in a situation that the capital structure now include both a loan, like a bond?
Okay, right again.
And they give us a cost of...
Let me answer your question. Point number 2. If a company is financed by equity and debt, point number 2.
Okay.
If a company is financed by both equity and debt, the appropriate discount rate is the weighted average cost of capital.
Okay, work. All right, sir.
Your work.
All right, sir.
Is that clarifying?
Yes, sir.
All right, let's go on. Now, the discount rate, please apply your calculator. 15% year 0. That will be 1. 15% annuity factor year 1 to 3. Please compute. Annuity factor year 1 to 3. Please compute. $2.283. Thank you. 2.283. Let's get the present value. 1 multiplied by 20. That's 20 million negative. Please multiply. 2.283 multiplied by 7.5. What do you have? Oh, yeah. I have 40 minutes more. Where is AY? You should not take time now. Yeah, your calculator should near you.
17.1225.
17.1225.
25.
17.1225. Please, the MPV, positive or negative?
Going to be negative.
Negative
Minus,
what, please?
minus 2.8775.
2.8735. This project is
775.
775.
5.
This project is not viable. Move to project B. Project B. Project B is for 5 years. Yeah.
Yes.
0, 1 to 5. The cash flow from project B,
6.5.
20 million. Initial, 6.5. Discount factor, 15%. Please get year 1 to 5, 15% discount factor. This one, present value, is 20. Yes, are we ready for this?
3.352.
3.352. Then present value multiplied by 6.5.
21.788.
21.769
88.
approximately.
Okay, sir.
Your MPV, 1.7
9.
million. Project B is viable. I move to project C. Year 0, 1 to 3. My cash flow for project C is for 5 years.
Yes.
Initial outlay 30 million.
30.
Cash inflow 8 million. My discount factor 1, 2 points, no, 3.352. Then the present value 30 million negative. Please multiply.
26.816.
816.
26.82. Thank you. MPV
3.182 minus negative
3.184.
18.
2, Abby.
3.184.
Negative.
Yes.
Project C is not viable. This is project C. I'll move to project D. Year 0, year 1 to 3. My cash flow, initial amount
10 million.
10 million. Cash inflow 5 million.
5 million.
My discount factor 1.
2.283.
83. The present value, 10 million. Please multiply what you have here.
11.415.
11.415. 415. The MPV 1.415. So only project B and project C and project D viable. Let me use red ink here. Viable projects. Viable projects. All right. What is the cost of project B? 20 million. Is that not, please?
Yep.
Yes.
It is.
What is the cost of project D?
10. 10
10
million.
million.
10 million. That
Yes, sir.
means we are going to finance project B and project D. That will cost us 10 million. Out of 50 million, we are going to spend 30 million to finance Bible project. We are left with what?
20.
20 million.
Thank you. Let's move to the next. Let's move to the next stage. This is question on Binco, okay? Binco workings. Working one. All right, we can move to the new page. You can now come here. Profits available. $50 million.
No.
Cost of viable projects. Viable projects. Projects B and D, 30 million.
Yeah.
Amounts for dividends, 20 million. Recommendation. Oh, am I spelling? Eraser. Recommendation. Company can pay 20 million as dividends. Alternatively, based on M and I don't like this. Based on M and M, M and M theory comma the company can pay 50 million as dividends or pay no dividend at all. Is that clear, please?
It's clear.
Yes, sir.
This is the position of M. You are done with requirements A. You are done with requirements A. Recommendation, the company can decide to pay 20 million as dividends. Alternatively, based on Modigliani and Miller theory, the company can pay 50 million as dividend or pay no dividends at all. Or pay no dividends at all. Any question, please?
Yes.
All right. Let us move to the B part. Being co-working. Working. Now the B part. Please pick your question, I will read. Prepare notes. Requirement B. Prepare notes on which you will base your contribution to the board meeting. This should include a brief explanation of the Modigliani and Miller propositions on dividend policy and reasons why the company's board may decide not to pay the dividends which you have indicated in A above. You should bear in mind the fact that most board members have little or no accounting knowledge. Your comment must relate to particular circumstances of BINCO services. Requirement B is note writing. Examiner says, prepare a note explaining Modigliani and Miller theory and explain why the company may not accept your recommendation. You have recommended a dividend payment of 20 million, or the company should not pay dividend at all, or the company should pay 50 million based on Modigliani and Miller. why would the company not accept your recommendation? Yes? Who is explaining? Please, explain to me what is Modigliani and Miller theory. What are the assumptions of Modigliani and Miller theory? Why would the company not accept your recommendation in A? Yes, who is speaking? This is note writing. AY. Modigliani and Miller theory.
Hello, sir, are you on B?
Yes, we are on B.
Okay, please. I lost contact, please. Can you recap on B again?
No, the question says we should write a note on Modigliani and Miller.
Okay.
You have the question with you, fine.
Yes, sir.
Yes. The question says, write a note explaining Modigliani and Miller theory. Explain to the board. Remember that the board member, they don't know anything about accounting. So explain. Who is speaking for us? Manuel. Yes, who is speaking? I need to move out of this question and take another question. It's fighting. Yes. Ayo, I'm waiting for you. We are waiting for you, AY. I hope you didn't just log on. You are now sleeping. Let's look at the solution. Look at the solution. Oh, it's not even here. Oh, deliberately. Okay. Now, if you have to explain this, we are going to talk about Modigliani and Miller. The same thing we explain here. We are going to talk about the theory, the same thing we explain. Okay, look at it. Modigliani and Miller developed a theory that suggests that dividend policy is not relevant. The company can decide to pay dividends or not to pay dividends. This will not affect a company's market value. According to Modigliani and Miller, what determines company's market value is the ability of the company to generate sufficient earnings, not the company's dividend policy. The argument of Modigliani and Miller was developed upon certain assumptions. These assumptions include: one, a tax-free economy. A tax-free economy. 2, no transaction cost. 3, no issue cost. 4, a perfect capital market, an efficient market. When you explain this, you now move forward. You now continue. According to M&M, a company can decide to pay all its profit as dividends. Where this is done, and the company need to finance new projects, the company can issue new shares, new projects. The company can issue new shares in order to raise finance for the new projects. Because there is no issue cost, company will not incur issue cost. Alternatively, the company can decide to retain all its profits and pay no dividends, provided the company can identify viable projects and invest in viable projects. Value of the company will continue to improve. You continue. Where a company is not paying dividends, any shareholder that require dividends can sell some of his shares in order to manufacture cash dividends. Where a company is not paying dividends, any shareholder that requires dividends can manufacture cash dividends by selling some of his shares. Since there is no transaction cost, when you have explained this, you now put a clause that in the real world, M&M theory may not work. In practice, Modigliani and Miller theory may not be practicable because it was developed on certain assumptions that are not realistic. Company will pay tax. Investor will incur tax on capital gain. There's issue cost. There is transaction cost. There is no perfect market situation. Then the last aspect, why would the company management not accept the dividends you have recommended? You have recommended 20 million based on Modigliani and Miller. The reason is the company is known to be paying dividends regularly. From the question we read, Binco Industrial Services, look at this. Most of the company's profits are distributed as dividends. Bimco Industrial Services is known for dividend payments. If you now introduce M&M, you can decide not to pay dividends or pay dividends. The existing shareholders will react. The shareholders are used to getting dividends. We are now bringing in Modigliani and Miller that will make you not to pay dividends. The shareholder may react negatively. Hence, the company's management may not accept your recommendation. That would be your expected response to the question. Any question, please? We have about 13 minutes. I can only take question 3. Let's look at illustration 3. You can check your study pack. Page 160. Illustration 3. It is argued that shareholders are indifferent between dividends and capital gain, and that the value of a company is determined by the earnings power of its assets and investments. That statement is the statement of Modigliani and Miller. Hello? That statement. It is argued that shareholders are indifferent between dividends and capital gain. If you like, pay dividends. If you like, don't pay dividends. Reinvest the money. If you reinvest the money, I can sell my shares and make gain. That gain is called capital gain. The value of the company is determined solely by its earnings power, by the earnings power of its assets and investments. You are required to write short notes on the following. 1, cash dividends. 2, scrip dividends. 3, scrip issue. This number, that requirement A is for 6 marks. It's ICANN tested question. Please, what is cash dividends? Who can differentiate between scrip dividends and cash dividends? Scrip dividends and scrip issue. Yes. To save time, cash dividends. Yes, I'll listen. Yes, no problem. You can speak.
Okay. Cash dividend is a form of dividend that is paid out of the distributable profit in form of cash to shareholders.
Great.
Why script, sir?
Continue. That's correct. Please continue.
Why script dividend or stock dividend is a form of dividend in form of to shareholders in form of new shares, not cash.
Okay. That's fine. Can you differentiate between script dividend and script issue?
Script issue is same thing like bonus issue, like it taught us. It's like capitalization issue. It is the issue of additional shares to existing shareholders in form of bonus.
That's correct. Script issue is bonus issue. Issue of new shares to shareholders at no cost. It is the capitalization of equity reserves. All right. Now look at the B part. Island PSC has just made earnings of 2,250,000. That earnings represent profits. The directors are trying to decide on dividend policy. If they retain 20% of earnings, they believe that they can achieve annual growth of 5% in earnings and dividends. If they retain 10% of earnings, the growth will be 2%, and shareholders will expect a return of 14%. You are required to determine which retention policy will maximize the value of the company shares. You know, we have two policies now. 20% retained earnings or 10% retained earnings. Which one will maximize the company's share value? Let's go to this quickly so that we can round up the class and move to other things. I'll come here. Dividends policy 20% retention. Please, you must be able to interpret question fast. So if there is 20% retention, it means 80% dividend payout. Is that not, please? Hello?
Yeah. Yes, sir.
Since we are retaining 20%, that means we are paying 80% dividend payout. Is that clear, please? Fidelis. Zainab, is this clear, please?
Yes, it's clear.
Okay.
Yes, sir.
Now, examiner says if you have 20% retention, what is the growth rate, please? What is the growth rate, please?
5%. 5%.
8%. Now let's calculate value of company. Value of company. What you are going to use is dividend.
Gordon.
Thank you. Gordon growth model. Gordon growth model formula. Gordon value of company becomes is equal to dividends year 0, 1 plus the growth rate divided by cost of equity minus the growth rate. Please, what is the company's earnings? Earnings how much? 2,250,000. Calculate dividends. 80% dividend payout, 80% of earnings. Please compute.
1.8 million.
That means, let's put it here so that you can, if you are looking at it later, our DO is equal to 80% of 2,250,000. Yes, what do you have, please?
1.8 million.
1.8 million. 1.8 million into bracket 1 plus G. Our G is 5%. 0.05 all over. What is the cost of equity? Check the question. Are we checking the question? Look at the question. What is the cost of equity? Is there?
%14.
Yeah. Shareholders will expect a return of 14%. That return of 14% is the cost of equity. Cost of equity is return to shareholders. Please, what is the value of the company? Work this out. Final answer, value of company. Please, final answer. I can't hear you.
21 million.
21 million. $21 million, right?
Yes, 21 million.
You can send in a chat. 1.8 multiplied by 1 plus 0.05.
Size 21 million. She's correct.
Okay, thank you. 21 million. For the first policy, value of company is 21 million. Let us look at the second policy. We can save this. This is working on question 3. Working, I'm trying to save it. 1, question 3. The second policy says 10% retention, Abi. Is that not, please?
Yes, definitely.
10% retention, that will mean 90% dividend payout. Is that clear, please?
Yes, sir.
90% payouts. You state your formula. Value is equal to DO bracket 1 plus G all over KE minus G. Get your DO. 90% of earnings. 90% multiplied by 2,250,000. What do you have, please? What do you have?
2,025,000.
Thank you. 2 million. Oh, where is this stuff hiding? Okay. 2,005,000. What is the growth rate if 10% is retained?
2%.
2%. Cost of equity,
14%.
14%. I can come here. Value is equal to 2,025,000 bracket 1 plus 0.02 divided by 0.14 minus 0.02 value. Final answer? 17 million.
$17,212,500.
500. So, which one maximizes the company's value?
The first one.
Policy or two?
One.
Policy one.
Thank you. Recommendation. Your recommendation. The company should use policy 1 should be adopted because it maximizes the company's value. Policy 1 should be adopted because it maximizes company's market value. We are done with that question. Thank you, Anne. Lastly, state 3 advantages of retained earnings to companies. Please, what are the advantages of retained earnings? I have treated this under finance success. What are the advantages? 1, retained earnings are readily available. Let me go and write it self. You can write it down if you like.
We are writing, sir.
1, retained earnings are readily available. Benefit of retained earnings 1. Of retained earnings 1, retained earnings are readily available. Point number 2. Point number 2. Point number 2. There's no cost. The company will not incur issue costs on retained earnings. The company will not incur issue costs on retained earnings. Then point number 3, the directors do not require the approval of the shareholders. The directors do not require the approval of the shareholders in order to utilize retained earnings. The directors do not require the approval of the shareholders in order to utilize retained earnings. Thank you, and God bless.
Thank you, sir. We appreciate, sir. More parts available.
All right. We are done with this topic. Thank you for your time. Thank you for the extra time we took. We are taking like 10 minutes extra. May God give us a better understanding.
Amen.
Good night.
Good night, sir.
And let's
Thank you,
remain
sir.
blessed.
Thank you, sir.
Thank you.
Yeah.
Thank you, sir.